And we are live, ladies and gents. How we doing? Good evening to you. 6 p.m. British summer time. Currently raining here. Not very summery. Man, the market is going wild today. You've probably got one eye on the markets. That's okay. That's cool. We'll run through in a moment what we're going to cover today. And if you're trading USD JPY, it's trading like some sort of meme stock at the moment, swinging around wildly. Lots going on. Exciting times in the market. This discussion today, this webinar today, I think is going to help you a lot. So what we're going to do is going to run through quickly 10 trading strategies. I say quickly, we've got 45 minutes. We'll do 15 minutes Q&As, get your questions ready. And at the end, I'll answer any questions you have. If I can't get to all of them, you can always email me. And the best way to email me actually is to reply to one of my daily emails. That'll find its way to me and I'll send you a reply back. If you haven't subscribe to daily emails, tradersmastermind.com/email to get on that list. All right, so what have we got looking at housekeeping? Oh, of course, we must have the disclaimers. Now, boys and girls, ladies and gents, boys and girls, you should know how risky trading is. So please understand the risks getting involved with this game. There are good potential rewards, but there are also downsides. It's that game. We don't get a free lunch anywhere, so please understand the risks involved in trading with leverage. Okay, so other housekeeping bits for you. Pepperstone have good timing. Pepperstone, well done. They've reduced their spread on the US 30, which is the Dow equivalent, effectively down to 2 now, so pretty competitive. And when you look at the daily range of today, if you're a day trader or scalper, you're getting a lot of bang for your buck, so to speak. So check that out. If you are a client, you can go and obviously navigate to that. If you're not a client, check that out as well. Okay, what else have we got? I'm looking over here at my screen. Okay, so how is this going to work? You're going to like this one. I spent a lot of time doing this, putting these slides together, bringing in example charts from my own kind of research and bits and pieces, finding new ones. So I really enjoy putting this together. So how this is going to work is this. So this week, we are going to do trend trading strategies. Next week, we're going to do mean reversion. That'll be the last webinar I do for the summer. We'll have a break in August, and then we'll probably be back in September with new topics, maybe psychology, bits and pieces. I'll get your feedback on that, guys, see what you want to cover. Okay, so how this is going to work is different from the usual deep dives. I'm going to run reasonably quickly through the charts. So we're going to have a kind of process. So the process is this. I'm going to explain the setup, the rules of the setup, the entry criteria for the setup, where you put your stop and where you put a target. And target, actually, we're going to use a fixed 2-to-1 just to make it easy. But the thing is with these is I'm also going to show you examples of the chart setting up. So in the real world as traders, right, we're on the hard right face of the chart. We only see that bit and how it plays out. So I've kind of chopped off that part so we can see it setting up in the exact rules when they're triggering. And then I'll run through one that's a losing trade and one that's a winning trade. Because in reality, managing the losers is just as important, if not more so, than dealing with the winners, right? And these setups and strategies obviously aren't always going to win. And so you need to be able to see, hey, where's the stop going to be? How does this play out over the long term? So as always with these strategies, guys, just do your own research on things like this. Regardless of where you are in your trading, it pays to do your own research and build your own, not only from a perspective of, hey, who could I be? By the way, maybe I should introduce myself. Mark Holstead, been trading 2 decades plus now. Consider myself a short-term trader, price action trader. You can find more about me on tradersmastermind.com. But regardless of what you think of me and how I share some of my experiences and things that have helped me, you should always do your due diligence and your own research just from a perspective of building confidence. So even if Paul Tudor-Jones came up here and said, this is a great strategy, you want to go and still dig into it yourself and develop your own rules that fit your personality so that you have the confidence to be able to trade it, understand where it's not very effective, where it can be effective, and that type of thing. Because that's the sweet spot in trading. And also understanding context. A lot of these, even though you're going to talk about strategies and setups and go, have this discrete rules, if you like, or fixed rules for a better word, the context is so important. And that's where you dig in and go, actually, this would be better under these conditions, not going to work so well in these conditions. So that's for you to dig further. Maybe we'll pick some of the best ones and dig into those later on another webinar and kind of really dig down. By the way, if you are a day trader, think it was the last webinar, 2 ago, day trading playbook webinar. That really digs into building your, if you're a day trader going into the trading day, how to look at context and build context. The reason I thought of that was talking about context just now, to build your own context up and to understand the context of the market and which strategies to deploy in that market. I think that's a really good webinar. I got some great feedback from that. I really enjoyed doing that. It's a 2-part webinar series as well. Designing your own customized day trading playbook, I think was the title, or something similar to that. But you can search for it and you will find it on the, you can go ahead and tradersmastermind.com actually, and it'll be on there as well for you. All right, so let's get going. Great quote here from Peter Lynch. In this business, especially for trend trading, in this business, you're good if you're right 6 times out of 10. You're never going to be right 9 times out of 10. So that's the way we're approaching it. We're not looking for something that's constantly right. We're looking for something that, okay, is right maybe the majority of the time, but it's that risk-reward ratio, the amount we're making when we win versus how much we lose when we lose, that's important. That's so key. And I know that you read the basics in the front textbook Trading 101. You need to ride your winners and cut your losers. But that's so important to remember when we're building a strategy, when we're building a playbook, when we're building a plan, is to say, hey, these strategies and setups, do they give me opportunity to make multiple reward on my risk-reward ratio 2 to 1, 3 to 1, etc. All right, so let's get going. So I think I've covered most of this. I'm going to run through quickly, show you the setup beforehand, the losing winning example. These are core ideas I like to use. You need to apply more filters to develop them further, like the context of the time of day. If you're oversold on a daily, have you got a daily chart structure, and test these type of things. These are here, quick fire round, blast them at you. You can take some notes and go, quite like that one, and dig in a little bit further. All right, so let's start off. And some of these, by the way, these aren't new. A lot of these aren't revolutionary. Trading's been around for many years, but my little flavor on some of them sometimes. So first one, many of you heard of this one, first pullback. So buying a pullback after an initial drive, looking for a continuation of the trend. I like this. This gets you early, potentially early on a trend. Very simple rule for this, pull back to a 20-period moving average. Again, we're simplifying all of these, and so just, you can expand this and do whatever you like to it, but for this webinar, I'm simplifying it right down to a very simple rule, just picking one of the ways you could do it. There are many ways you can get into this first pullback, but here's one. Stop idea, 50% of the initial drive, target 2 to 1, risk toward ratio. Let's have a look at a chart. So DAX 5-minute chart, as I said, we're on the hard right of the chart here. So in the real world, right, we're not looking at hindsight going, oh, that would have happened. Real world, this is what you'd see. You see the drive, open 8 o'clock UK time, DAX rips off. Nice, good, strong drive. Okay, now we see it pulling back, tagging that 20-period moving average, looks like a trigger. So we would potentially pull the trigger. How do we set this up? Here's how we'd set this up. The entry would be there at 16,093, touching that 20-period moving average. Stop will be down there at 16,063. Why? What I've done is I've taken the range from around 16,000 to whatever it's 16,130. And in some other examples, you'll see a little more detail about how we do that, but hopefully it's self-explanatory. Halve that, and we're going to use that as our stop loss, and then as our target, there's twice our risk. And in this example, target was hit. Another example here, when we take the trade to the downside, market opens, drive lower, we get a pullback, we structure it. So you can see we're starting to pull back. Actually, this is more interesting because I'm trying not to go off beast on some of these things, but as moving average tags the price, this is more like price stagnating and catching up, which is a subtle distinction. It might be one that you don't want to take. But anyway, real world, you see it, it tags, you're expecting a move lower. There's your target, twice your risk, there's your stop loss, and this one would have got stopped out. So 2 examples there of taking that first pullback. And I've used an example of trading at the open because I think the open gives you that drive, gives you that momentum, gives you that supply-demand imbalance that you can potentially capitalize on. Now, I can look at the chart today on my other screens, like today, some great trending moves. So it doesn't always happen at the open if you're trading currency pair or commodity, or maybe you're trading crypto, whatever you're trading, it's still that drive, that first drive that's important. We don't want to take it after subsequent tests. It's the first pullback really that this setup particularly is all about. Of course, you can take further pullbacks, but this setup exclusively, your strategy is that first pullback. 5-minute chart, 20-period moving average, you structure it, take your range, halve it for your stop, double it for your reward. Okay, the next one I've got is a traditional channel bounce. So a channel bounce is, channel maybe trend line's a better way of putting it. We're buying a pullback to a channel. Okay, and again, this is super simple. Some more complicated one, advanced ones perhaps later on, intermediate to advanced ones. So keeping it simple for now. But when the structure works, the structure tends to stay aligned, right? We see this structure happen quite often. And I think from my perspective, actually, from a personal perspective, when these have been going a while, I always like, oh, a bit late in the day. So I'm thinking that when you do want to take it, you want to take it really after, for the channel to form, you want 2 tests, and then really the 3rd test is what you want. So we'll look at examples in a moment, but entry on the touch of the lower channel. So if we're an uptrend, we're doing this. And the stop idea is below the last channel low. So imagine we get a test, better for example, target 2 to 1. Let's look at an example. So USD JPY, daily chart, we've had a couple of tests forming this trend line, and actually this is a channel. A channel is just basically another parallel line that runs a line, so say it runs parallel to the trend line. But the most important one is the support, or the one in the direction of the move. In this case, support. I can't help but look at that and go, that's not much of an angle, but real world, hard right of the chart, it's touching that support level. What do we do? How do we structure a trade? Here's how we could structure this trade. We look at the stop. We put the stop in first on this, which would be below the prior low. So you can see that prior low there. I've got the stop just below it. That was the last touch of the trend line. That's really what we're not necessarily prior low, actually. It's definitely the touch of the trend line. Stop goes just below it, and the target we're just doubling. And this is just an example here. All use that sort of target to kind of showcase the fact that we can have a risk-reward ratio of 2 to 1. And these still can work out in the wash. You might want to just go for prior highs. You might want to go for further targets depending on what you're trying to do, what you're trying to achieve. So it's a daily chart example, comes back, tags. That would be our entry as we tested that level. And in this case, we got a really nice explosion, exploded up, hit the target. Let's look at another example that didn't work, because it's important to see both sides of the coin. Downtrend, same currency pair. USD JPY, which is swinging wildly at the moment. Downtrend here, you can see the channel is in place. Nice rhythmical rotations, ping-ponging back and forth. Structure's nice and intact. Comes back up, testing that level. Right, would you want to take this? Actually, if you took it at that point, one thing to know, if we go back, and I'm running through these reasonably quick, and I think the pace is okay. Q&A, stick your questions in if you have any, guys. That 130 level, I think that, if you see where the stop would have to be, the last touch of the channel was over at kind of 134.50, something like that. So if you're doubling that for your reward, you're asking for quite a lot, right? 120, and I'm listening, if you're a swing trade, that's fine. And obviously, if there's an intraday chart, it will look a bit different. But this is where, these are good examples to see where you would add maybe a filter to say, meh, stop's a bit wide on that. I can't really expect that target. That's probably multiple rotations deep. Do I want to do that? Maybe I'll wait for something a little bit more structured and play a little bit more of a strategic game, but just keeping it simple and not curve fitting for these purposes. I want to show you this as well. So there you go. There's a stop out on USD JPY. All right. What have we got? Oh, yes, the bull flag. Gotta love the bull flag, ladies and gents. Gotta love the bull flag in the right conditions. I think you can kind of just do bull flags forever. Bear flags as well, obviously, just taking the other side of it. So we've got the momentum again, the drive, and many of you know what a flag is. So let's look at how we potentially trade that. So we get the drive, and a flag is basically where we just sit in a high tight range. Ultimately, that's what it is. And we want to enter on a break of highs. Now, caveat to that, real world, you might want to be a little bit more aggressive on that, buy a break of lows that fakes out, but we're keeping it simple. Stop will be below that flag low. Again, we're going to use a 2 to 1 risk-reward ratio. Let's look at pound US dollar. Let's look at cable here on an hourly chart. All right, so we get an entry, we get a drive, good nice drive, get a flag on hourly, and we're buying a break of the high. Stop it going below the low of the flag, simple, and we're using a 2 to 1 risk-reward ratio. We're keeping things nice and simple and structured. In this example, bang, we hit our targets. Okay, so another one here is flag, good drive. It's got to be a good drive. Nice structured stop under that low of the flag, buying a break of the high, targets there, very clear structured trade. This one didn't work out, you stopped out quite quickly. But with a 2 to 1 risk-reward ratio, you can see how if you're right 50% of the time, that's going to work out okay. And this is the key, and really one of the sort of things I want to get across here is that these are all very simple structured trades, right? There's nothing secret and revolutionary here. Where you deploy them is where you put your own secret sauce in. For one, I don't really like that word in trading. It's something secret, but your special sauce, if you like, and how you make it your own in the context is important. But it's just to show that the risk order ratio structure can work out using very simple kind of setups, ways to identify that supply demand imbalance. Because ultimately all we're doing with these is saying, hey, we believe there's a supply demand imbalance, right? We believe there's a trend, conditions are activated or potentially activated, and we want to jump on board that trend. And so what we're doing now is we're saying, well, how can we jump on board that trend with quantified risk? Because anyone can jump on board a trend, right? You can just buy a trend, you can buy highs, you can do this, do that. But what we're trying to do is find a little pattern that we believe is repeatable. That means we can jump on that trend, put the stop in a very structured place, and then decide where we're going to put the target. And we've used 2 to 1 in all this. Now, the reason we do this is number one, to improve our discipline, right? If we see a trend, very often you feel like, oh, I want to take it, I want to get involved, I want to buy this, I don't want to miss out. And obviously the FOMO comes in, all the other nonsense emotions that we potentially get. But when you've got structure to the way that you get into the trade, you can say, no, I'm going to wait for that first pullback. I'm going to wait for a flag break. I'm going to wait for a channel test, or whatever you decide to do. And that, the main thing about that, not necessarily the structure of the setup and the pattern, but it's you being able to step back and go, hey, you know what? I don't get involved with anything just nonsense. I'm going to wait for something where I can structure my stop in a good manner. Because if we think about getting involved in a trend and just buying, where do you put your stop? It's very difficult to know where to put a stop in a trend unless you've got a structured pattern behind it. That's why many people get caught out in the trend, because you buy, you think, oh, I'm going to buy, but then it's pulling back. You're like, well, I don't know if I want to stop there because it's pulling back and I really would have been buying there, but and you end up kind of having a stop that's too wide to really accommodate the genuine target for the trade, or your stop's too tight and you get the death by 1,000 cuts. You're trying to keep a tight stop on a trend, ping, you're out. Before you know it, you've risked 10 times the amount you wanted to risk in the day anyway. So all these are doing is creating a bit more structure to how you would get on board a trend. So let's look at range break fake. Another one of my favorite patterns. Those of you guys know me know this is, I've loved this trade for more than a decade. In the right conditions, I think this is a fantastic trade. It's just beautifully a way to structure a trade. Does it work all the time? Absolutely not. Of course it doesn't. But it, when it does work, it's great. When it doesn't work, it's a very fixed, very quantified place to put your stop. So buying a breakout of the range after a false break lower. Entries on the break of highs. Stop idea below the range low. 2 to 1 risk order ratio. Let's look at an example. Easier to look at an example than make shapes in the sky with my hands. All right. Nice range here. Lows, highs. We see price break to the downside, comes straight back up. Now in this setup that I'm sharing with you now, we're buying a break of the high. All right, so we're buying a break above 1949. One of the things you might want to do if you're a more advanced trader is to buy as it comes back up through that low. So as it comes lower, takes out that 1916 low, 1960, 1920 low, then pulls back up. You might want to be a bit more aggressive and be buying there. But for this example, let's stick with a kind of real cookie cutter way of trading it, which is I've seen the fake out. I've seen a lot of traders trap short. I've seen a lot of longs get stopped out. And now we're going to push, and we're going to push through to highs. So we're taking it as a long through highs. And let's see how that would be structured. So we're putting our stop just below the low of that range. We don't want it to come back and retest that. Now, some people might say, well, really, we should have it below the low we went to. And I would agree if we were taking it on the break back up through the support level. But as we're taking it through the high, that's wide enough. You really want it to go. The idea is that it's like this slingshot catapult, gets pulled back, doesn't continuate, and then bang, it's being let loose, and all that momentum is just the kinetic energy is just firing it through the highs. So you're buying it here, and this is quite a high target, right? It's quite a wide target. So again, context is key. Where you trade this is key. If you start messing around with this in a real kind of nonsensical environment, you're probably not going to get your target. But it's one thing with this range break fake. The longer it's been sitting in the range, the more people have just been battling it out. And the beautiful thing about this trade is that you can let people battle it out. You can say, there's my range. I'm not getting involved in it until we either break the high or the low and we fake out. You've got a structure, you've got your standard of when you're going to get involved. And the more people are battling out, you can see these people battling left, right, and center. All of a sudden it breaks. Some people are getting scared, somebody getting stopped, somebody getting excited. Then it swings back the other way. Imagine if you're this trader who's trapped on the other side of this deal, you feel that emotion. You're a new trader. We've all been there as a new trader, trapped on one side, flicked around the other. That's what we're leveraging on. Those people who are trapped on the short side and then just whips back up, takes out that high, and it's the momentum. And it's that, you think about supply demand shift, it's the little sniff of price as it goes through lows. And then no, there's no more sellers and we get the momentum. This one didn't work out, went through the highs, rotated back lower, and we were pinged. Another example here on USD CAD, nice range, dip below the low, it's setting up, pretty good. Let's have a look. Breaking through the high, we belong at 133.5, give or take. Our stop will be below that low. There's our target. In this case, we had some momentum come and some sort of real aggressive move that worked out well. Nice. So this is something that it can be really useful to trade. And again, risk-reward ratio helps things come out in the wash, even if you've got 50-50 risk, even if you've got 50-50 chance of expectancy. But in my experience, that's way better than 50-50 range break fake used under the right conditions. All right, another one for you here. This is an intraday one. So intraday traders, especially if you're trading, actually, you know what? It's not just the indices. This is Forex. This is actually anything that trades, you know, more volume and more has more volatility in a kind of time window. So if you're trading, you know, maybe you're trading USD CAD during the US session, or maybe it's USD JPY US session, that type of thing. Or if you're trading a Dow during the open or DAX during the underlying cash session, should I say, this works really nicely. So again, we're letting the trade start to initiate. This is when the trade just getting going, okay? And this is, again, this is why it's so beautiful, these plays, is we're waiting for something to happen. So the trade goes off without us. Let's say we didn't get involved in the trade, fine, off it goes. We now switch to a 3-minute chart. I know it's unusual, but go and have a look yourself. This pattern is pretty decent. We're buying the first oversold condition on a 3-minute chart during an uptrend. I'm using the stochastic settings 14.33, I think, but it doesn't really matter too much. But within that, use the 14 period on the 3-minute chart. And as price comes, or as the stochastics come from oversold back up, we're then going long. And I'm not a huge fan of indicators. It's not, you know, I'm not an indicator fan massively, but what we're trying to do here is the problem was this: how do we get on board this trend that is rallying, maybe has pulled back once or twice, but we often got this deeper cycle sort of midday? How can I frame way to get in that? Because you quite want to use classical TA and kind of look at support and breaks of that. But is there an indicator that might help me? And this worked out quite well. So again, this is a decade plus old strategy for me. As price comes back from oversold, there's your entry. And a stop idea is, again, I'm just using a good systemized way of trading this, half of the range. So the half of the range from low to high, we use that as a stop. And the target idea of prior high. Okay, so this is the NASDAQ equivalent of Pepperstone, the US cash 100 CFD 3-minute chart. We get the rally. This is the hard right of the chart, don't forget. Rallies hard, starts to flag, forget all that stuff. Now it's rotating back. The first oversold condition on the stochastic, 3-minute chart, intraday, good, tick, tick, tick. Starts to roll back up. This would be our entry. And here's how we structure this. So we're going long at that point there. And the reason I've got these boxes is we're kind of quantifying how much target and stop to do. So we're basically saying, hey, where's this come from? How much room have we got? So in other words, you know, from high to low, we're taking that range. I've used the fib tool on TradingView, but I've just taken deactivate everything but the 50%. And for illustration purposes, what I've done then is I've taken the box tool, rectangle tool, whatever it's called in TradingView, and then I've just gone, right, there's 50% of the move. If I take that, copy that box, and then put it on my entry, that's going to be my stop. So there's a long-winded way, there's plenty of ways of doing it on TradingView, but a long-winded way of basically saying it's 50% of the move from the high to the low. So the pullback move, basically, easy way of thinking about it. 50% of that move from your entry underneath. And this is wide enough to accommodate, you think about it, if you're already buying on a pullback, any deeper, we start looking at a V-shaped reversal or an inverse V-shaped reversal. We don't want to be involved in it. So it's a nice sort of level to put your stop, wide enough to accommodate a little bit of noise, but not so wide as it's back under the lows, which I think is a little bit too far. Some people like to do that, but not for me. Okay, so went long on here. And this case, we got stopped. Our target would have been at the high. There's our stop. Didn't really get going. Let's look at an example that did work. So we go again, same market, same conditions. Excuse me, good drive, pull back, 3 minutes oversold, starts to pick back into neutral territory. Here's how we structure the trade again. Don't forget, high to low. I've got the target here. You can see you've hit the target, but here's how we structure the trade. High to low, that little pullback, it would take 50% of that for our stop. We target is in this case, I think I've done double the stop, but you could do fresh highs, bang, targets hit. And actually, this is one that very often you might get a close at the highs at the end of the day. If you're trading this intraday, you're looking at it from that perspective, you might want to hold on to it and go, you know, I'll peel a little bit off, I'll feed some out, sell a few contracts, sell a few lots into the high, and then see if we close at highs for the end of the day. Okay, another one here. Afternoon break. So the afternoon break is again, I do like this under the right conditions. I have to say, I really do like this one. You get a trend day, you've not got on board the kind of opening drive trend, and you wait, and you say, okay, let it do all its thing and sit around and oscillate and retest and mess about. But if it breaks out again in the final 3 hours of the trading day, and I'm using kind of the regular trading hours, I'm trading the DAX or the Dow, something like that, then I'll take a breakout, right? So it's a very simple breakout trade. And one caveat with breakouts is that under the right conditions, they are beautiful, beautiful. And this probably self-explanatory, right? But the key to breakouts is knowing to filter when you're going to take it. If you've got a nice explosive environment, good solid trend day, and you know, right, if you've been trading for a while, you can look at a chart and go, that's a trend day. You don't need any rules or stuff. You can just eyeball it and use experience to go to a trend day. So the beauty of this setup is you can go, right, let it become a trend day. Don't get involved and sucked in. If you've missed it, fine. Wait for the final 3 hours, and then you can buy a break of the highs. Break out of the highs, stop idea, 25% of daily range, target idea, another 50% of daily range. There's an example. Again, good old NQ or NASDAQ or US 100 if you're trading the Pepperstone CFD equivalent. Here we go. We've put a high in, what is it, 4:30, nearly 5 o'clock, right? And we've chopped around and messed about and gone back and forth, not a lot has gone on. Everything's gone very boring. Actually, the 3 minute cycle trade as well. But then look, it's actually starting to come and approach the highs. So as it approaches the highs, we go, great, there's the highs. We structure the stop, 25% of the range, and we would buy a break of the highs. There's your long, there's your stop, there's your target. In this case, you didn't quite hit it, but a rule I would suggest is at the end of the day, you close the trade. It's an intraday momentum trade, this. Nothing more than that. Afternoon breakout, intraday momentum. Let me add this. If you were, I don't want to overcomplicate things, I promise myself not to overcomplicate this stuff. I can't help going off piste a little bit. If you were analyzing this on a daily chart, daily time frame chart, and you thought perhaps you were kind of swing trader, then maybe you would say, I've got a bit of cushion, I'm going to look for a day 2 follow through. But if you're a pure day trader, you probably want to close the book and go flat into the close. So fine, you didn't get quite your target, but it was an okay trade nevertheless. All right, here's one. And by the way, I know there's not many equity traders. Most people do trade currencies. Most people do trade indices. Excuse me, but if you're trading equities, this works even more with more momentum with this stuff. There's your structure. You've got a high test in the morning, comes back, messes around, goes to low, blah, 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 swings around. You don't care. You're an afternoon breakout trader. Bang, 6 o'clock comes. Is that enough time? Yep, we're in time, in our time window. Off we go. We're long there at 196. Our stop's at 181. Target's 216. Easy target, hit, no problem. Job done. Very nice little setup that under the right conditions. All right. I've got another one for you. Okay, it's crude. Afternoon breakout. There's the entry. We've got a good chug. And by the way, I'm using not the regular trading hours on crude. No, it's a 24/5 product. But if you're saying, hey, I'm going to base it on the underlying ETF and the options and all this type of stuff, you might say, okay, I will use the regular trading hours cash session as a sort of proxy. Bit of a trend started. Off we go, chugging to highs. Is it the right sort of time? Yeah, we'll take it. Breakout there. There's our entry. Stop 25% of the range. Target 50% of the range. Does it go? Doesn't go this time. You're out. You closed it. Okay, let's keep moving. Are we still, people still with me? Yeah, reasonable amount of people here. Okay, good. I'm glad you guys are enjoying it. Q&A, stick your questions in if you have any as you go, and get to those at the end. Opening range breakout, talked about this so many times, but I love this setup. I won't go over old grounds. Did a dedicated webinar exclusively to this where I went into some real good detail on this one. But I wanted to include it because I'd be remiss if I didn't, because I think it's such a powerful way to get involved in a trend. And if you go to tradersmastermind.com/trading-strategies, click on opening range breakout, a real deep dive into that, including a recording of this webinar, including a recording of the opening range breakout webinar I've done. You haven't checked this one out. So trade thesis here, buying a breakout in the first 15 minutes of the trading day. And by the way, you can use this if you're trading Forex too, Asian session, US session, London session, I missed a session, Sydney session you maybe want to do, but you can kind of chunk it into sessions and work out exactly either way you want to take the opening range break. We're taking a break of highs, first 15 minutes bracket, stop at 50% of the range as an idea, target 100% of the range. Here comes the S&P 500 ETF. I'm just using this as a proxy to show us the gap, and it's quite easy to kind of display it with this. So 5-minute chart, there's our 15-minute range. So we would be long above that 446.77. Our target would be 447.68. Our stop will be 50% of the range, high to low divided by 2, right in the middle there. Bang. We almost get target rolls over and stops us out. Okay, real world, guys, this happens. I wanted to include all these losers as well so you can see what it looks like, because this is the real world. We're going to lose lots and lots and lots of trades. And if we can manage the risk, we can keep the risk sensible and less than the money we're making on the winners, we're okay. It's fine. It's not a problem. It's not a dirty word loss. All right. Here's one here. We'll spy again. There's a 15-minute range. We take a long, bang, very, very quick target on that one. There was a gap lower that popped back up, but you can see the structure of that. 4 to 34 was the long. Stop was half the range. Nearly got banged on that wick, but we came up and we hit the target. Final targets were achieved, 2 to 1 in the bag. Okay. New high range break. So this one's subtle, and I think you'll like this one. If you like price action, you like this one, because there's a little subtlety, a little nod to price. So after price breaks highs and consolidates above highs, that's the sweet spot with this. We then buy a further breakout above the consolidation zone. And many of you are like, oh my God, Mark, I can't chase this damn thing. It's too far. It's already done its move. I don't like it. And I'm with you. I hear me out. I don't like doing that too. The later in the move, I'm like, oh God, I just can't bring myself to buy it unless I have a nice structured place for the stop. This is why this is so nice, because what you've done is you've pushed the highs, you've broken through highs, you've consolidated, which almost resets price to me. It's accepted that level, it's consolidated, you've got a now structured level. It's got rid of, forget about what's happened. We obviously want to see it because that's the precursor for the move we're trying to take. But as it pushes to highs, it's consolidating. We're now going, okay, one further pop, please. One further pop. And it almost resets the spring, if you like. The spring stretched to reset it by consolidation rather than pullback. We're ready to go again. Entry to breakout highs, stop below the consolidation range. Target idea on that one, 2 to 1. Again, keeping it nice and simple. Let's see what we got. So we break above the high, 129.6. We consolidate. That's the key here. And then bang, we take a push to highs. There's our stop. In this case, we get our target pretty quick. Second one here, what have I got here? Cable consolidates above highs. Same type of thing, but look at the subtlety here. It's the consolidation above highs. We've got a whole day, almost half a day, where it's sat above that prior high from early June. That's prime. That's ripe to go. The stop is very easy to get in. The stop is quantified, should I say. The trade is very easy to get in. Taking it as an entry above the highs. There's our target. Off we go. Didn't get it this time. Stopped out. Okay. VWAP KISS. So the VWAP KISS, one of my preferred setups. I like this a lot. And if you listen actually to, if you listen to Traders Mastermind podcast, thank you so much. If you aren't, then check out, what's it called? Developing DAX Day Trader. Where I talked to a day trader who, developing trader series is people who are, who've got some momentum, right? They were struggling, now they've kind of got 6, 9, 12 months of consistency, and they're just turning that corner. And one of the traders on there was a guy who trades the DAX, and he trades the VWAP quite a lot. So if you like the VWAP, that's worth a listen. Anyway, back to the setup. The thesis is this. After that trending morning, price comes back to test the VWAP. And we just very simply go long on a test of VWAP. The stop is 50% of that range from VWAP to high. And then the target idea is 2 to 1. Let's look at an example. So good old Facebook, or Meta, as they call it now. What have we got here? Good drive higher. Nice. There's nothing really ambiguous about this. We're at the hard right of the chart, and I think you and I both agree. It's a trending day. It's coming back. There's our VWAP. By the way, you use, I know I'm looking and pointing at that screen. You can't see that screen, but you use the anchored VWAP tool on TradingView to anchor your VWAP to the open to get the best possible kind of reading for this. Price comes back. You just buy along at the VWAP. And I don't want to go into why the VWAP is so effective. I've got a little bit of write-up on my site on that. And I think I've done, if I haven't, I definitely should do a deep dive into VWAP, because it's such an important tool and indicator to have regardless of what you're trading, I think. Because it's an institutional benchmark, all these other type of stuff, algos kicking at that level, etc., etc. Anyway, we're pulling back. The VWAP's at 304.44. You would just start arbitrary long there. And the stop is 50% of the high to the VWAP. So what I mean by that is we take the largest move away from the VWAP to the high, and we use 50% of that. And you can use a tool on TradingView to help you with that. But again, we're using a real arbitrary area without trying to be too clever at saying, hey, this is where the trade would be negated. And in actual fact, there you go, your target's going to be the highs because it's just twice the distance. So we go long at 305, stops at 303.69. Do we hit the target? Yes, we do, quite late in the day, but that's fine. We can wait, no problem. And we get the target filled at 309 there. It went a little bit lower, as you can see, which is why I think sometimes you've got to give this a little bit more room. There is a scalp trade that I believe you can still do on the VWAP. But for this purposes, we're talking about a structured intraday trade. You leave your stop in, entry in, your stop's there, your target's there, you wait and you see what happens. So this is a VWAP KISS trade. Another one here on the short side on good old Netflix, same structure, pulls back. We're going short 434, target 431, 435 is our stop, 50% of the range. What happens here? You already know because I show you a winner and loser. This one gets stopped out. Actually came back and was ping-ponging back and forth, but I think it's a reasonable place for a stop. Hey, you know what? This is the point. I mean, this is the thing, man. We've got, if we focus on the losers, the rest of it almost takes care of itself. How many times is, you know, we get stuff where you lose more than you intended, you're fighting, clawing back, it takes you ages, and then you have to lose a big bunch again. And if you just put all your attention on minimizing those losers and just accepting the stop and walking away and not having any emotional attachment to it, you can be frustrated, you can be angry, you can be all that kind of stuff, but letting it dissipate, next trade, follow the process, things start to work out. All right, Wick through support. Pretty simple one, this. Price test support, breaks, recovers, forming a wick. Now, notice a theme here. All of these trades give you a good place to structure that stop. We're buying a break of highs, stop is under the wick, risk-reward ratio 2 to 1. Let's do an example, boys and girls. Here we go, the DAX. We have a little bit of support put in intraday there, all in the pre-market session, should I say. Nice pre-market session support. Wicks at the open, comes straight back up. We put a stop under the wick. We're long there, 16.021. Our target's twice our stop. Nice opening trade this. Tagged pretty quickly. Loads more meat in it, but we don't care. We're not in for that. We look at that tug, 2 to 1 structure on the trade. And you can see the wick there a little bit better because you couldn't quite see it. Well, it's not bad there, but you can see it a bit clearer there. All right, one that didn't work. Some support, 2-day support on the hourly chart on the DAX. Wicks through. Looks great. There's our stop. There's our target. Fits in with the structure about as well. We're not looking for anything unreasonable. In this case, just comes down, pings us out, choppy open. That's fine. So I'm going to get caught taking trade after trade after trade after trade at the open. Bad place to be there. You don't want to be on the back foot on starting the day, red, and going, God, got to spend the whole day clawing it back. One loss is fine. Recalibrate, reassess, come up with a new plan. Off we go. And that, ladies and gents, is it. Wow, I covered that quickly. I didn't realize how much time I had. So we've got the first pullback, the channel bounce, the bull flag, the range break fake, 3-minute cycle, afternoon break, opening range break, new range high break, VWAP kiss, wick through support. 10 setups for you to pick and choose the ones you think are valuable or not. You might say, I like one of these. I'm going to dig into it and do a little bit more due diligence, research, and work out exactly what I'm going to do. Or you might say, you know what, 3 or 4 of those will fit nicely into my playbook. And that's the idea. That's really what I want to do, just give you some different ways of structuring your trade. I also want to mention that you can, I'm going to give you a copy of these. I know there's so many charts here, and I'll run through quick, and 10 was an ambitious number to do, and we're going to do another 10 next week, a mean reversion, and I've purposely gone through it quickly. But if you want a copy of these, the easiest way to do it is to go to tradesmastermind.com/ORB. You will get the opening range breakout engine tool, which basically helps you test out, it's a trading view tool, helps you test out trading view. But the reason I've done that is I can attach a copy of the slides to that. So you can go to there, put your email address in there, and at the end of the next webinar, I'll send you all of these charts. So you can prune off all these slides. I'll just send you the slides, but you can delete all the slides you don't want. But then you've got your own little compendium, if you like, of these, and you can catalog them yourself and start to build your own playbook if you want to. You might be like, I don't care, but maybe you do, and maybe you can build those and start to build different examples of flags that worked, that failed, first pullbacks that worked, that failed, VWAP kiss, whatever. Maybe you use those as kind of a little tweak them, adjust them to suit you a little bit better. I don't know, but I'm going to give those to you anyway. So make sure you go there. If you've done it already, then I'm going to send those out to you regardless. But if you haven't, make sure you do. Okay. That was quick. I think 10, maybe she's done 5. Hey, we've done 10. We're on time. Let's have a look at Q&A. Any questions, ladies and gents? Feel free. Oh, we've got some time. Let's see what we got. Questions. Okay. Let me see who we got. Daniel. Thank you, Mark, for sharing time today. Appreciate that, Daniel. Thank you for your feedback. Good day for a trend day webinar. Yes, indeed. I rang up and I said, excuse me, can you put a trend day in, please, on NASDAQ and Dow. We're done in trend and strategies. Thank you very much. 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 Who else we got? What SM would you use for applying these strategies on 1 hour and 4 hour time frame? What SM would you use for applying these strategies? What SM? Am I missing something? SM. Put it in, Susanna, what you mean by SM when you would use for applying these strategies. I mean MA. Okay. I was thinking, well, 25 years in this business and there's a new terminology. Wow. All right, yeah. Or moving averages. If you use a 20 period on that 5 minute, so on that first pullback trade, it would be a 5 period, 20 period on your 5. If you're, do you know what? The thing about moving average is this, and I think we've discussed it a little bit more, but let's stick on it because it's a good question. You should calibrate what you're using depending on the pace of the trend. So if you've got a really aggressive trend, right? It's really aggressive. A 5, and I know that sounds super tight, but if you're trading off a 5, it will bounce off that 5 while we've still got that massive demand coming in. If it's a little bit less shallow, a 10 is going to keep you aligned. If you're prepared to kind of sit and wait for a broader pullback, a 20. Any deeper than that, I'm not really interested. But I know that sounds like a bit of a vague answer, but that's one of the best things to do is to really look at the conditions. If it's a real aggressive move, then use a kind of 5 and play off that 5, bouncing off the 5. First close below the 5, you're looking for a close above, this type of trade. If you're kind of looking for a broader move, the trend's not as aggressive, but it's still there and valid, then go a little bit wider. Examples I gave, I think with the first pullback, that's a 20 period moving average on your 5 minute chart. That's your first pullback one. That's a nice structured one. It's a nice easy settings to use. These work, Dan says these work for swing trading. Also, yes, Dan. Yep, this is exactly the type of thing you want to do in a swing trading environment. USD, JPY, this type of stuff is moving. And your job, you're going to get fewer opportunities. Well, it depends what you trade. If you're screening across a bunch of markets, fine, you're going to get maybe a few. But yeah, absolutely. You know, especially that range break fake type trade where you get the range, it tries to go lower. And I would also, I'd actually even suggest, Dan, that type of thing is a little bit more powerful on a higher time frame because you've got the whole weight of like it spent the whole day under a level and then it's come back rather than just a 5-minute move. It spent the whole day, it sucked all those traders in, they're caught, it swings all the way back, and we start to break to highs. So yeah, absolutely. And the beautiful thing you've got down in for a swing trader is you can just be calm and you can say, hey, that looks like it's setting up. That is setting up. Let me let it do what it needs to do, and I'll pull the trigger when we're ready to go. You know, and that I'll get some channel examples that were on a daily chart, but the range break fake is a lovely, lovely trade to take, in my opinion, anyway. On a swing trading basis, because it just resonates, right? It's trapping people. On they go. We're going short, breaking out. No, we're not. See you later, boys. And then we just rocket into the high side. And you've got time then to position and structure for that. And to go even deeper on that range break fake example, as you come back up through the low, you might be considering a long. You're structuring your stop below the low and adding into the trade as you break to highs to really kind of squeeze as much juice as you can from that. So absolutely, you obviously do your own research, do some due diligence scans on the markets you like to trade, but the concept is the same, right? It's that supply-demand imbalance, whether we're trading intraday or whether we're trading over multi-day. That's all our job is as traders. And I'd argue that all we need to do is become a specialist at reading certain supply-demand imbalance conditions, and as a retail trader, that's enough. If we just leave the rest of the scraps for people to fight over, and we go, actually, when I've really got the supply demand imbalance and I can time that kind of pause and then the re-aggression that's coming back on, that's something that's repeatable. And your game then is just to make sure you're not getting sucked into trades that aren't ticking the boxes. You want to be able to be very, very prudent and careful about when you're deploying your capital. That was a good question. Where are we? Awesome presentation so far. Thank you so much. I'm pronouncing your name, Reggie Albert. Reggie, or was that an I? I can't see it from here. It's right over there on my other screen. Thank you very much. Is it possible to get a copy of this recording and send via email to you? You will get a copy. If you signed up via GoToWebinar, via Pepperstone, they will send you a recording. Robert Reed, there he is. This is great, Mark. Thank you. The 20-period MA bounce is one of my favorite trades. Yeah, a good day for it today too. Yes, it was beautiful. The RSI coming back from overbought, oversold works well too, just like stochastic. Yeah, good move. Good man, Robert. You use stochastic, use RSI, use CCI. Any of those kind of oscillated things work. I just have used stochastic for a while on that. Works well too, just like stochastic. I like to add this as additional confirmation for a trade, and also helps when deciding where to take profits. That's a good point. And let me add to that, Robert. Thank you for bringing that up. You can then wait. What's the beautiful thing about some of these setups is you can wait for the conditions to come to you. So if that's stochastic, if you're doing that, using the RSI stochastic, waiting for it to become oversold, it's there. You're like, I'm just going to hold back. I'm just going to hold back. I'm just going to wait. I'm just going to wait. Just going to wait. You don't. I mean, how many times have we done this, guys? We've seen the price and we're like, it's stalling. I'm in. Now you're like, well, I'm not going to touch it until we go oversold and then curl back up. It's a very structured trigger. And a structured trigger means you don't overtrade. And for many traders, overtrading is the nemesis. So if we can do anything to add more structure to the way we trade, then that's just better, right? That's just better. So having it come into oversold, wait, sit on your hands, gets oversold, starting to curl back up. And if you're adding as extra confirmation, that's cool. If you're not, and you're having a standalone trade, then great. But yeah, that's a really good point, is that it just extra confirmation or just a filter to stop you getting involved in all the nonsense. Emmanuel says, good day. I've been looking for a particular strategy to focus on. Haven't seen any good ones. Could you help me out? Emmanuel, you have 10. You have 10 there. What? I've blasted you with 10. Pick your one and dig from there. And the idea is that, hey, the reason I've just thrown 10 at you is you go, I quite like that. And then that's a rabbit hole for you to go down and dig. You go on YouTube, you go on websites or whatever, and you just dig into bull flag, and you'll find loads of stuff, but you just create your own rules. And it sounds like you're a new trader, potentially. Very quickly, have we got time for this? We have. As a new trader, this is what I always say to newer traders. is, just pick one market for now, intraday or swing. Pick one strategy for now. You can always add more, but pick one and just get to learn that strategy, how effective it is, when it appears, when it doesn't appear. Start to note down some things and start to become accomplished and specialist at that strategy. You can have more in time, you can have more markets in time, but start there, because then you will start to see the subtleties and the nuances and different structure and this and that, the other of how price moves. And you can go, actually, I prefer it when this happens, or I prefer it on this. And then you add maybe another strategy. Then you maybe add another market if you want to. You probably won't, because you don't need to. You'll be like, okay, this is enough. But pick one that resonates with you. Or, and I know at the beginning, like, well, I don't know, it resonates with me, Mark. God damn it, I'm a new trader, blah, blah, blah. Just start with one. It doesn't mean you're always going to end up there. It doesn't mean that's the way you got to tattoo it on your arm and go, I need to trade bull flags. You don't have to do that. You can start this and then just iterate through. And if you find yourself tendency to buy pullbacks in trends, trend trading is strategies one to focus on. If you like to fade trends or like to fade highs and fade lows, then next week we'll go through some mean reversion stuff. And I'm going to fire 10 at you that you can probably pick one or two that you like. Ajuka Parkonen, thank you. Appreciate that. Very interesting topic. Good. I'm glad you like it. Thoughts on ICT strategy? I know a little bit about it. I'm not really a follower of other people's strategies, only because personally I don't like to be clouded in my judgment. I will dip into other things and see if I can get inspiration maybe, but I kind of got a journey in a 3, 6, 12, 5-year, 10-year plan of where I'm kind of moving things. And so I'm a bit cautious, but I've heard of the guy. I don't know who he is, but I've heard of it makes sense. Like the basics I've heard of it makes sense, like liquidity and coming back and probing the zones, and the terminology he uses. The stuff that you hear is all supply demand. There's different ways of looking at it, there's different ways of framing it, but it is all supply demand. And if, listen, at the end of the day, if that resonates with you, you grab that one thing, whether it's something I've said or something that someone else has said, it doesn't matter. It's just like, grab it, run with it as much as you can, make it your own, make sure your risk is structured, make sure the stuff is doing it, and stick with it for a bit. The trap, that's the word, trap, could be different words. The trap that a lot of traders fall into is trying something for a bit and then getting, sexy strategy syndrome. There's a sexy strategy over there. Let me try that. And you never give it enough chance to get traction. So if you like that ICT strategy, or if it's got multiple strategies, I'm not sure. If you like the way it looks at it, then dig in. If you like one of the things that I've said, dig in. If you like someone others, then dig in, grab it, and then go as deep as you can. And then you look and audit and say, well, how did it work for me? Does it work for me? Maybe it does, maybe it doesn't. What's good, what's bad? And then you go, before you make changes, and look at something else, or you iterate and adjust and adapt that strategy. So yeah, that's my broad feedback on that. I hope that's valuable. Where are we? Peter Daniel, hi. Would you say that any of the strategies work better or worse on different instruments, or does the instrument not matter? And only the price action matter? Well, Peter, I feel like you're opening a trapdoor for me there, sir, because I know your answer is that you think all markets are the same, all prices the same. And, to some extent, I think you're right. I have a slight different view on it, as you know, but you are a swing trader, you are a longer term trader, an intraday trader. I think that when you're trading, let's say an explosive stock or something that's got one-way action, these are probably going to work better. You've got an index and there's a lot of people buying equities. It's going to work a little bit better than a currency pair. However, that argument is completely ruined today when I look at things like USD JPY or look at Euro USD the last few days. So I think it's up to you, right? I know you do things slightly differently to me. I know you're asking these questions for others' benefit because you're a very experienced trader. I think that you have to get a strategy that suits you. And I know you preach this as well in your calls, is find a strategy that suits you, find something that really fits with your personality, and then put it in the market that you like to trade and go, hey, actually, you know what? I think mean reversion is better in this market because actually USD CAD's a little bit more mean reverting at the moment, or maybe trending markets better trending trend strategy in NASDAQ, that type of thing. So yeah, that's a good question, Peter, and I know it's a good question. Who have we got here? Baz, what is what's the highest indicator, not necessarily an actual indicator of volatility? What's the highest indicator, not necessarily an actual indicator of volatility? Okay, obviously you got your VIX, right? If you're trading S&P 500 and the US indices, the VIX is the volatility index. That's probably not the question you're asking. You could look at something like distance from moving average or MACD, not bad. If you're trading the indices like the S&P, the Dow, the tick index is a really good indicator of volatility. I think you can get, I'm not a huge indicator guy, I have to say, but there is, ADX isn't bad, but it's more of a trending tool. Right now, Linda Rashke uses ADX. ADX above 30, I think, indicates a good trending environment. That would be not a bad one. What's another one you could use? Bollinger Band width. That's quite a good indicator. I'm thinking on the fly here. Bollinger Band width is quite a good indicator of volatility. Keltner channel width. Bollinger Band width is kind of the standard deviations away from the moving average. Excuse me. So that would probably be a good one. I can think of anything else. I hope there's a few there that I hope that's answered your question, Baz. Traded DAX yesterday and had 6 successful trades out of 7. Good for you, Agnes. Today made 6 trades and stopped out on all 6. Okay, not so great. Use same strategy in both days. Is my lack of success today just a case of wrong strategy on the wrong day? Here's what you do, Angus. Here's what you do. So if you've had 6 successful trades out of 7, you look back and you go, right, what were the conditions yesterday? So it was DAX, right? You look back and you go, what were the conditions yesterday versus today? Did I do anything differently? Was my preparation differently? Did I sleep well? Was there anything external that I could influence that affected me positively that day? So you audit that. Then you audit the day type. So was the day type trending day? Was it an oscillatory day? Was it a mean reversion type day? What was it? And then you audit the strategies you were deploying and go, hey, was there a difference? Now, it might just be that that's the way the cookies crumble, so to speak, right? You've had that run 6 out of 7, then you had 6 losers. I would actually suggest, I don't know, obviously, your plan and the way you approach stuff, but I would say that quit before you have 6 losers. The mental damage of 6 losers, I mean, okay, I don't know your full plan, I don't know all this type of stuff, but I would argue that maybe if you've had 3 losers in a row, that might be time to call it a day and go, hey, you know what? I'm probably not aligned with conditions. So, and this is, you didn't ask me for this advice. And again, I'm not giving advice. This is what I would do. If I had 3 losers in a row, I'd pull the plug and say, come back tomorrow. But audit with your performance, see what's going on, see if there's any difference to what's happened. Okay. Who have we got? Thank you very much. Greatly appreciate it. Ezadine, good to see you. Andre, thank you. Yeah, that's a good question about tight stops. Killing my trades is tight stops. Yeah. Last couple of questions on this one, but that's a really good question. What's your name there? Enuma. Yes, brilliant question. Death by 1,000 cuts gets so many traders. That death by 1,000 cuts is such a it's such a horrible way to get out that get hammered by the market, because you're in a trade, you think you're right, you drag the stop right up, and then you get pinged. Right up, you get pinged. Keep it wider, and actually you end up risking more than you wanted. So here's something to try: is widen your stop, reduce your size, and then just see how the trade plays out. Because it could be you've got an effective strategy, but your stop loss management's too tight, and you already kind of know that. But then the answer is, well, where do I put my stop? So start really wide, see how the trade goes, have a kind of time period you hold the trade for, and then audit maybe 5, 6, 7, 10 trades and go, hey, how far against me? What's my maximum MAE, which is my maximum adverse excursion? How far away from the trade did that go before, how far against me did the trade go before it came back? And then you can go, right, actually, I sit through, let's say 40 pips of drawdown on average. So I need either a stop that's wider than 40 pips, or the other lever to pull there is to say, actually, I need to improve my entry. I need to be a little bit better. I'm a little bit early on my entry, so I need to get better at that. So that's something to look at. Last one, ladies and gents, you can send me an email if you like, and I'll get to all your questions. What are your thoughts on, this is Baz, what are your thoughts on the trading pattern that involves distribution and liquidation stages. I'm not sure about the exact name, but you get what I'm asking. Yeah, you know, that concept is just another terminology for that, you know, congestion area or a consolidation area. You know, and then the idea of the liquidation is if you go right down into the order book level, which I don't anymore, but something I used to look at a lot, you would have, you know, if you're sweeping the order book and there's people taking liquidity, moving the price higher, it would kind of leave a little bit of a vacuum, liquidity vacuum on the bid. And sometimes that would get filled later on in the day. So that, I mean, there's ways of looking at stuff, but ultimately simplify things to supply demand imbalance if you can. And I'm not saying don't look at these things, absolutely. You know, if it makes sense to you, by all means do it. You know, I'm not a trader who says you must trade this way and no others. That's not true. You should find something that works for you and resonates with you and you understand. But yeah, that distribution of, okay, I'm going to run through price levels. There's a little liquidity vacuum. It's going to leave liquidity. That's basically when you're integrating volume and kind of thinking more on a structural level. And, you know, market profile maybe comes into that because it integrates volume a little bit. But that's really adding an extra layer of volume in. And yeah, fine. I'm not a huge follower of that type of stuff, but I can see why people works for some people. Right, ladies and gents, I think we'll have to call it a day there because Peter's starting his call. Really quickly, thanks very much. Thank you very much. Thank you very much. Yeah, sorry guys, I'll have to. If you really want to ask me a question, reply to my daily email and just put FAO me and I'll get it. I'll look at it. I'll reply. But thank you so much. I know we've got a few questions here, but we're probably out of time. Anyway, thank you very much, ladies and gents. I appreciate your time. I appreciate you coming on next week, same time, same place, 6 o'clock. We're going to rock 10 mean reversion strategies. Thank you so much. Keep your risk managed. See you soon. Bye-bye.